If you think you need thousands of dollars to start investing, you're wrong. If you think investing is only for rich people or finance experts, also wrong. Today I'm showing you exactly how to start investing in 2026, even if you only have $100 and zero experience. Let's get into it. Welcome back to Finance Byte. Here's something wild. If you invest just $200 per month starting at age 25 with average stock market returns, you'll have over $500,000 by retirement. But if you wait until 35 to start, you'll have less than half that amount. Time is your biggest advantage, and every month you wait costs you thousands of dollars in future wealth. I know investing feels intimidating. The jargon, the apps, the fear of losing money, not knowing where to start. I felt exactly the same way. I waited way too long to start investing because I thought I needed to understand everything first. That delay cost me real money. But here's the truth. Investing doesn't have to be complicated, and you don't need to be an expert to build wealth. Today I'm breaking down exactly where beginners should invest their money, what accounts to use, how much you need to start, and the biggest mistakes to avoid. Before we dive in, make sure you've got your emergency fund in place. If you haven't watched that video, I'll link it in the cards. And if you're new to Finance Byte, hit subscribe because we're building financial freedom together one video at a time. Alright, let's talk investing. Step 1. Prioritize tax-advantaged retirement accounts before anything else. This is where beginners should start. And honestly, where most of your investing should happen for years. I'm talking about for 401k plans and Roth IRA letters. These accounts give you massive tax benefits that supercharge your wealth building. If your employer offers a 401k with a company match, that's your absolute first priority. Here's why. Let's say your company matches 50% of your contributions up to 6% of your salary. If you make $50,000 and contribute 6%, that's $3,000 per year. Your employer adds another $1,500 for free. That's an instant 50% return on your money before it even grows in the market. You cannot beat that anywhere. I don't care if you're paying off debt. I don't care if you want to invest in individual stocks. I don't care what else you think you should do with your money. If your employer offers a match and you're not taking it, you're literally turning down free money. Contribute at least enough to get the full match. That's non-negotiable. After you max out your employer match, open a Roth IRA. This is my favorite account for young investors. You contribute after tax money now, but all your growth and withdrawals in retirement are completely tax-free. Think about that. If you put in $100,000 over your career and it grows to $1 million, you pay zero taxes on that $900,000 in gains. That's incredible. For 2026, you can contribute up to $7,000 per year to a Roth IRA if you're under 50. That's about $583 per month. You don't need to max it out immediately. Even $100 or $200 per month is building serious wealth. I started with just $150 monthly and increased it as my income grew. Step 2. Invest in low-cost index funds, not individual stocks. This is the most important advice I can give beginners. Index funds are the secret weapon of smart investors, and they're incredibly simple. An index fund is basically a basket of hundreds or thousands of stocks packaged into one investment. For example, an S&P 500 index fund owns shares in the 500 largest U.S. companies. Apple, Microsoft, Amazon, all of them. When you buy one share of an S&P 500 index fund, you own a tiny piece of all 500 companies. Instant diversification. The stock market has averaged about 10% returns annually over the past century. Some years it's up 30%, some years it's down 20%, but over long periods it trends upward. Compare that to picking individual stocks. Research shows that over 90% of professional fund managers can't beat the market consistently. If professionals can't do it, beginners definitely shouldn't try. When you pick individual stocks, you're gambling on specific companies. You might win big or lose everything. With index funds, you own the entire market, so you get the market's average returns, which historically have been excellent. Here are the index funds I recommend for beginners. For U.S. stocks, look for a total stock market index fund or an S&P 500 index fund. Vanguard's VTSAX or VOO, Fidelity's FZROX or FNILX, Schwab's SWTSX. These funds own thousands of U.S. companies and have expense ratios under 0.1%, meaning you pay almost nothing in fees. You can also add some international diversification with a total international stock market fund, something like Vanguard's VTIAX or Fidelity's FTIHX. A simple beginner portfolio might be 70% U.S. stocks, 20% international stocks, and 10% bonds if you want more stability. Or honestly, you could just put everything in a target date retirement fund and call it done. These funds automatically adjust your allocation as you get closer to retirement. Step 3. choose a brokerage, and actually open your account. This is where people get stuck. But it's easier than you think. For Roth IRA letters and regular brokerage accounts, I recommend 3 platforms: Vanguard, Fidelity, or Charles Schwab. All 3 are excellent, trustworthy, and have 0 commission fees on stock and ETF trades. Here's how to actually do this. Go to the website of whichever brokerage you choose. Click Open Account, select Roth IRA or individual brokerage account. Fill out your basic information like name, address, social security number, employment info. It takes about 10 minutes. Then link your bank account so you can transfer money. Once your account is open and funded, it's time to buy your first investment. Log into your account. Search for the index fund you want. Let's say you want an S&P 500 index fund. Type in VOO or FXAIX in the search bar. Click Buy. Enter how much money you want to invest. And confirm. That's it. You're now an investor. Here's the game changer though. Set up automatic investments. Most brokerages let you schedule recurring transfers from your bank account and automatic purchases of your chosen funds. I have mine set to pull to $100 every payday and automatically buy more shares of my index fund. I never have to think about it. It just happens. This is how you actually build wealth, not by trying to time the market or making emotional decisions. This strategy is called dollar cost averaging. You invest the same amount regularly regardless of whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this smooths out your average cost and removes emotion from investing. You're not trying to predict the market. You're just consistently investing for decades. Step 4. Match your investments to your timeline. How you invest depends heavily on when you'll need the money. If you're investing for retirement and you're in your 20s or 30s, you have 30 to 40 years before you need this money. That means you can handle volatility, because you have decades to recover from market crashes. A general rule is to subtract your age from 110 to get your stock allocation. If you're 25, that's 85% stocks and 15% bonds. If you're 45, that's 65% stocks and 35% bonds. The younger you are, the more aggressive you can be because time heals all market wounds. But here's what you need to understand. The stock market will crash multiple times during your investing life. That's not a possibility, it's a guarantee. In 2008, the market dropped 50%. In 2020, it dropped 34% in a month. If you invested $100,000 and watched it turn into $50,000 or $66,000, could you stomach that without panicking and selling? This is why beginners need to know themselves. If market drops cause you to lose sleep and make emotional decisions, you might need more conservative investments, like a 60-40 stock-bond mix instead of 100% stocks. But if you can stay calm and keep investing during crashes, you'll make incredible returns because that's when stocks are on sale. The worst thing you can do is panic sell during a crash. The investors who made the most money during the 2008 financial crisis were the ones who kept investing or bought more when everyone else was scared. Every market crash in history has eventually recovered and reached new highs, every single one. Your job is to stay invested and keep contributing. Step 5. Don't make these costly beginner mistakes. Mistake number 1. Trying to time the market. You will never consistently buy at the bottom and sell at the top. Nobody can. Stop trying to wait for the perfect moment to invest. The best time was yesterday. The second best time is today. Time in the market beats timing the market every single time. Mistake number 2. Investing money you'll need in the next 5 years. If you're saving for a house down payment, or a car, or anything you'll need soon, do not put that money in the stock market. It's too risky. Keep short-term money in high-yield savings accounts. Only invest money you won't touch for at least 5 years, preferably decades. Mistake number 3. Paying high fees. Expense ratios matter more than you think. A 1% fee versus a 0.03% fee might sound tiny, but over 30 years, that difference costs you tens of thousands of dollars. Stick to index funds with expense ratios under 0.2%. Mistake number 4. Getting distracted by crypto, meme stocks, or get-rich-quick schemes. I see beginners all the time who haven't even started basic investing but want to put money in some random cryptocurrency or the stock their friend mentioned. No. Build your foundation first. Max your retirement accounts, invest in index funds, and then if you want to gamble with 5 or 10% of your portfolio on speculative stuff, fine. But don't skip the fundamentals. Mistake number 5. Checking your portfolio constantly. I'm serious. Checking your investments daily makes you anxious and leads to emotional decisions. Set up your automatic contributions. Check in once a quarter to rebalance if needed, and otherwise ignore it. The more you check, the more likely you are to make a mistake. Quick answer to the question everyone asks: how much should I invest? Financial experts recommend saving 15 to 20% of your gross income for retirement. If you make $4,000 per month before taxes, that's $600 to $800 per month going toward investing. But if that feels impossible right now, start where you can. $50 per month is better than zero. $100 is great. The goal is to start and then increase your contributions every time you get a raise, bonus, or finish paying off debt. I started at $100 per month, and I'm now investing over $1,000 monthly. It took years of income increases and intentional choices, but it's possible. Here's your priority order. 1. Contribute enough to get your full employer 401k match. 2. Pay off high-interest debt above 7%. 3. Max your Roth IRA if possible. 4. Go back and max your 401k up to the limit. 5. Invest in a taxable brokerage account for additional wealth building. Follow that order, and you can't go wrong. All right, Finance Byte family, let's recap how to start investing in 2026. Step 1. Open tax-advantaged accounts like 401k and Roth IRA. Get your employer match first. Step 2. Invest in low-cost index funds, not individual stocks. Step 3. Set up automatic investments through a brokerage like Vanguard, Fidelity, or Schwab. Step 4. Match your risk to your timeline and stay invested during crashes. Step 5. Avoid beginner mistakes like timing the market or checking constantly. Your action step this week: open a Roth IRA and make your first investment. Even if it's just $50 or $100, getting started is what matters. Drop a comment telling me where you opened your account or what index fund you chose. Let's celebrate taking action together. If this video helped demystify investing, smash that like button and subscribe to Finance Byte for new content every Monday, Wednesday, and Friday. Next video, I'm doing a deep dive into index funds versus individual stocks so you understand exactly why I recommend what I recommend. Thanks for watching Finance Byte, and I'll see you in the next one. Now go start investing.